regarding the example we just finished, which is dividends received from two corporations with which we are not connected. I didn't say it explicitly, but I want to now. Our RDTOH gets 3833 from Part 4 tax here, and also 3833 from Part 4 tax from this dividend, thus a total of $7,666. So we just fill in this RDTOH bucket from both dividends on which we earned, or on which we paid Part 4 tax. Next question. Same facts. Own some shares of this Pubco. Own some shares of this CCPC. Now, watch carefully. 9% becomes 11%. 9% becomes 11%. Now we have more than 10% of votes and value. Now, my holdco is connected with this company, which I will call A corporation. Question: how much? Oh, an A corporation pays a $10,000 dividend to holdco, just like before. Part 1 taxable income. 0 is correct because of
112. 112.1.
112 bracket 1. How much is the Part 4 tax? Well, if we're not connected, it's simply 38 1/3%. So says A. B applies, 186(1)B applies when they are connected. And here we need to know what amount of dividend refund, if any, A corporation, the payer of the dividend, enjoyed as a result of paying the dividend to holdco. And let me digress just for a second and give you a simpler example. Let's say that holdco owns 100% of A, 100% of this company. And this company pays a $10,000 dividend from A to holdco. And let's say this company gets a dividend refund of, let's make up a number, $1,583. $1,583 dividend refund in A. Because I guess A had some RDTOH, maybe it had a capital gain, or maybe it earned some interest income or something, and lesser of this and that provided A with a $1,583 dividend refund. Income Tax Act says, okay, so this company gets a dividend refund of $1,583. We're now going to charge holdco Part 4 tax of $1,583. Because this $10,000 is still sort of in the corporate realm. And we don't think it's right, so says the Income Tax Act. Income Tax Act says we don't think it's right that if this company gets a dividend refund, no tax gets paid up here. We want this company to pay tax equal to the dividend refund that its 100% subsidiary got. Otherwise, the tax system is messed up and unfair in some way. And I think the income tax system is right. I think that this company should pay Part 4 tax equal to the refund that this company got. And it does. And the tax that it pays is 100%, that is its ownership percentage of the dividend refund that ACO enjoyed because ACO paid a taxable dividend up here. I'll pause there. Everybody okay with that? Dividend refund here, Part 4 tax paid there, if we're talking about connected corporations. If we're not, if this 100% is instead 9%, then the Part 4 tax isn't $1,583, it's $3,833, because it's an A situation, not a B situation, i.e. no connection, full-on 38 1/3%. Connection will just make you pay your share of Part 4 tax based on your share of the dividend refund that was gotten down here.
And is that Part 4 tax that added to their RDTOH?
This Part 4 tax is added to Holdco's RDTOH.
Yep.
So then 1583 gets added here, 1583 plus 3833, 83 gets added to Holdco's RDTOH. 6, 11, 14, 5. Which now Holdco can use as a dividend refund as long as it now pays a dividend up to, well, me. And now I have to pay Part 1 tax, and I don't get any 112 bracket 1 deduction because I ain't a corporation. So let's change the facts a little bit and have you take a crack at what this calculation is. Now let's say that Holdco owns 11%, thus connected, and B got a dividend refund. It's a $10,000 dividend. Pardon me, A got a dividend refund of 0. This company paid a $10,000 dividend. Actually, what it paid was Holdco's share is 11%. So the total dividend paid is $10,000 divided by 11%, which is $90,909. I think I've got that right. $10,000 divided by 11% is a total dividend paid to not just Holdco, but other corporations or other shareholders. Total dividend $90,000. Our share is 11%, which is $10,000. And A got a dividend refund of 0. How much Part 4 tax does Holdco have to pay on this $10,000 dividend? The answer is our share, that is Holdco's 11% share of whatever dividend refund was got down here. Thus, no Part 4 tax in this transaction. No dividend refund here, no Part 4 tax. Change this to 9%, $3,833 of Part 4 tax. Under what circumstance would this dividend refund be 0? A has never had any SIB income or taxable capital gains or paid Part 4 tax on dividends. Or maybe it did, but it cleaned out its RDTOH a long time ago. But the most common reason is that A is earning only active business income. Thus, never had any refundable Part 1 tax, never paid any Part 4 tax. 11%, 0 Part 4 tax. 9%, $3,833, I kid you not. Your client says, yeah, I want to incorporate a holding company, and the holding company is going to own part of an operating company that I and some of my friends, these people over here, are all going to be shareholders of this operating company. Oh, how much are you going to own? 9%. Is there any chance that you could maybe own 11% instead? That would make things better in case this company pays dividends up here. Much better to have 11% than 9%, less Part 4 tax. Well, unless Holdco is always going to pay out dividends as soon as it gets money from down here, but I don't think so, because depending on the individual shareholder's tax position in a given year, the individual shareholder may not want to take dividends and pay 43% tax if they're not eligible dividends. Thus, much better to have owned 11% than 9% to avoid having to pay for Part 4 tax. So here's a set of facts that you might see on an exam. Holdco received a $10,000 dividend, and this company got a dividend refund of $17,000 on the total amount of taxable dividend paid. I'm going to read this to you. This company got this company paid Holdco a $10,000 dividend. A paid that dividend to Holdco, and also dividends to other shareholders who are out here someplace. Some are individuals, some are corporations, and the total dividend refund received by A on this total dividend is $17,000. How much Part 4 tax does Holdco pay? First question, do you need to know anything about the total dividend paid to everybody? No, not at all. All you need to know is how much dividend refund A got in total and how much your share of it is. 11% of $17,000, whatever that is.
$1,870.
1870?
Yeah.
That's the amount of Part 4 tax paid here, 11% of the total dividend refund received. That's it. There's nothing more to say about dividends. Except to say again that I find this whole system really elegant. We've got sort of dividends and SIB income filling up this whole thing, this RDTOH. Both making deposits and withdrawals. The rates sort of hang together. We've got sort of mystical rates like 30 and 2/3, whatever that is, and 38 and 1/3. And how does this all hang together? And I don't know, I personally just think it's beautiful, and that's all I'm going to say. Takeaways, big difference between 9% and 11%. Connected, more than 10% of votes in value. You can assume that whatever percentage I give you is both votes in value. Won't try to bifurcate the votes versus the value. Part 4 tax, not connected, really simple, same as if I own public corporation, 38 and 1/3. connected, thus 11 or 23 or 99%, simply look first at the dividend refund, our share of it. That's my Part 4 tax. Part 4 tax gets paid up here, and then someday this holdco pays a taxable dividend to the shareholder, gets a dividend refund, lesser of 38 1/3% of RDTUH account, or, pardon me, 38 1/3% of taxable dividend, or whatever in the RDTUH account, lesser of. In the spirit of going slow today, any questions before we move on? Because we're about to start a whole new section now about something else. Please turn to the textbook to page 328. To date, what is the advantage to incorporating that we have discussed? One word,
Deferral.
deferral. We'll pay a relatively, hopefully small amount of tax now, and pay more tax later when we take the money to the company, but meantime, as low as 9%. And we happen in this province to enjoy the lowest rate, 9%. 0% Manitoba, 9% federal. Just as an aside, as you know, the federal small business deduction is based on maximum $500,000 times 19%. So that's a reduction in tax. So we start with 28% minus 19 gives us 9. That's how we get to the 9%. Believe it or not, in Manitoba, the small business deduction, which gives rise to 0, isn't based on a $500,000 limit. And I say this just for your interest. For purpose of Manitoba tax, I'm quite happy if, for this course, we consider the Manitoba limit to be $500,000. But I will tell you that the Manitoba limit is something else. So I'm in page 18, 19 at the front of the Income Tax Act. So I'm on page 22, and if you look at that page, 22, Manitoba combined 9% and 12, active business income. Oh, pardon me, nil and 9%. Footnote 7. Threshold to which the CCPC rate applied started at 425, went to 450, only got to 500,000 as of January 1st, 2019. It is only now that we sort of, Manitoba did, have its small business rate equal to the rest of the country. It had run for a number of years. I'm going to say this happened in 2014. I believe this all started around 1998 or something. So we actually had three rates of tax in Manitoba. We had zero, and then the high rate, and then we had something in the middle on approximately $100,000 worth of income. And this would actually mess up planning in terms of how much money we take out of the company, like paying a salary or something like that, because we couldn't sort of have exactly the right amount of small business deduction. Now we're I'll use the word reconciled with the rest of the country, and I think that's a good thing. Just as an aside. Besides deferring tax, another reason to set up a corporation is to have more than one shareholder. So for example, a family unit, 2 spouses, because of progressive marginal rates, we like to try to equalize the income of one spouse with another. And therefore, if the major source of income for the family is a corporation, let's say that the family runs a business, also called a family business, might be nice to have 2 shareholders, spouse 1, spouse 2, and even children. Now we've got the ability to pay dividends out, or whatever it is we're paying out of the company, could be salaries perhaps. Talk more about this next week. And having 6 or 7 taxpayers, or at least 2, which will provide less tax payable for the entire family as compared to just one shareholder. Now, that could also be accomplished by, say, having a partnership of 7 individuals or something like that. But it's actually easier from a lawyering standpoint in terms of documentation to just simply issue shares. Issuing corporate shares is very easy to do. So the Act says, look, we get that and we completely understand it, but we feel like we would need to put limits on it. And the limits are what's called TOSI, which is tax on split income. And split income is a word used to say, well, I mean, there used to be only this shareholder, and now we're taking that shareholder's income and splitting it among these people, so we refer to that as split income. Income split up among other family members. The first rule among the TOSI rules is that if this is a minor shareholder, defined as simply less than 18 years old any time of the year in the taxation year of the individual, and we pay a dividend to this person, and this person is like 12 years old and has 0 source of income, of other income, and I'm going to simple tax successful business doing really well. This shareholder would take, say, $500,000 dividend this year, but instead has 5 family members, pays $100,000 each. each shareholder pays tax of only 11%. Total tax, $11,000. Times 5. $55,000 payable by the entire family, assuming that dividends are their only source of income. You might say, well, hang on a second. If I go to page 428, please do. Isn't the tax on non-eligible dividends like 43%? And the answer is yes, if you're in the highest tax bracket, which by the way this entire page is premised on. Your tax rate on non-eligible dividends is indeed about 43%, varies province by province. And I like what the textbook has done here. I mean, for the textbook to show an example, you sort of have to pick a tax bracket, and the textbook picked the highest tax bracket. And honestly, that's where the planning opportunities are anyway. The medical resident earning $80,000 a year isn't really motivated to do a lot of tax planning. But this family is, because if one person receives that $500, the tax is $205,000. One person, $205,000. Pick this one or this one, and this is for all 5 people, 55 grand. Income Tax Act says, okay, we see where we're going here, and here's what we're going to do. For this person, minor person, referred to on page 328. We're not going to touch the corporation. We're not going to change any dividend refunds, anything like that, but we're going to tax this person as if this person is in the highest tax bracket. We're going to tax this minor as if the minor is in the highest tax bracket. So the minor's tax, the so-called marginal tax rate is high. There is thus no benefit to having paid this minor $100,000 worth of dividend as compared to the otherwise owner of the company earning it. Because there's no way that paying tax at the highest bracket helps anything. An anti-avoidance rule is enforced. Dividends received by minor children, directly or through a trust, from a private Canadian corporation, I'll skip some words, referred to as split income, not subject to attribution rules. Attribution rule means trying to tax it somehow in the hands of this person. Hey, we'll just leave it taxable in the hands of the minor. That's fine, we don't mess that. But we're going to tax them at the highest rate. They're subject to TOSI, tax and splitting, a tax at the top marginal rate in the child tax return without the benefit of the personal tax credit. Ouch. Personal tax credit is something that everybody gets, except this poor 13-year-old. In fact, I believe that this, let's see what the footnote says. Yeah, this includes the personal basic tax amount, which is the personal tax credit referred to in the textbook. That's worth about $3,000 of tax savings that all of us get, not this poor kid. It's one of those punitive deals where actually we're better off not to have any minors be shareholders of our corporation. Another one of those punitive things is what we talked about before, personal services business. We just don't go there. We just don't incorporate personal service business income, and we just don't have minors be shareholders of a private corporation. As it also says on page 338, if a minor sells shares, so now the minor's looking at a capital gain, not dividend income. Minor's selling shares. And if the dividends on those shares would otherwise be subject to TOSI, taxation at the highest rate, the capital gain will be taxed as a dividend, which is mind-blowing. So the difference between taxation as a dividend, low marginal rate versus highest marginal rate, that's this difference. You add to that the idea that a capital gain might get turned into a dividend, a capital gain being only half taxable in the first place. That one to me actually is mind-blowing. Like that is a very punitive thing. So if we avoid having a minor be a shareholder because of the vanilla TOSI rule, dividends taxed in the hands of the minor at the highest tax bracket, if that's not scary enough, let's avoid having a minor being a shareholder due to the possibility that a capital gain could get taxed as a dividend at the highest tax bracket. TOSI does not normally apply to capital gains, et cetera, et cetera. Any questions so far? I'm giving you the bad part first. It gets better because there are some exclusions that apply, and I need you to know some of those, not all, but some. Under the category of getting worse, TOSI can also apply not just to minors, but to adult family members. So here we're talking generally about spouses and adult children. So the default, so here's a minor, and here are other children. So this is spouse 1, this is spouse 2, and this is adult children, child 1 and adult child 2. And the default is that TOSI applies to everybody, unless the following amounts are excluded, and only for adults, not for children. There's no way to get out of this for minors. Income received from a business that's not a related business. A business is related, i.e. bad, if a person related to the taxpayer is involved in running the business or owns 10% or more of the business. So you're getting a feel for sort of some kind of incestuous kind of thing where we're earning money from other businesses, other corporations, where there's more cross ownership among family members. Business owner is 65. The spouse can get released from TOSI. But the two that I want you to know, and which will be examinable, are two that are more important. Where adults 18 or over who worked more than 20 hours in the business in the year or any of the 5 prior years. So now we're talking about this person who actually spends a lot of time in the business. A lot of time being measured by 20 hours a week. Half time, or as most business people would say, 20% time. So the first one is time spent. These are 2 that I want you to know for the exam. These 2. The second is involvement by way of investment. So the first is involvement by way of time. The second is by way of investment. Amounts received by adults, amounts means dividends, received by adults 25 or older who own at least 10% of the corporation. Yes. Provided that less than 90% of the income is from providing services, so not a legal professional corporation. Let's say it's a manufacturing company, awesome. So if this person, A2, adult child 2, owns 10% of the corporation, we're good, as long as it's not a service company and not a professional corporation. Providing services, so all of these are bad, and providing services is bad. What kind of services? Landscaping. Personal services such as hairstyling. Financial services, haven't really thought about that one. That one will probably get litigated. For example, I know several insurance agencies selling life insurance or auto pack, whatever. I haven't thought about it, but I hope their advisors have, whether adult children who are shareholders would be caught by that one. I'm going to add 2 more. And that's my final. I'm going to add, if this person has actually put money into the business, then that person can take out some amount of dividends, referred to as a prescribed return on capital. I don't know what the prescribed rate is, but let's say, for example, this person actually invested $100,000 into the business. And if the prescribed return is, let's say, 5%, and if the person doesn't pass any of those other tests, that person can take out $5,000 a year as a dividend and not have TOSI applied. That's what that is. And the final one is capital gain on the sale of qualified small business corporation, which will be, in this course, the most important thing that you learn about. And I'll tell you briefly what it is, and we'll talk more about it later. If I sell the shares of my company, I can, and it's a real company that carries on business, I can earn more than $800,000 of capital gains tax-free. Selling the shares of this company, I can earn $800,000 once in my, well, the total of my lifetime, $800,000 tax-free. How much does that save? If I otherwise had to pay tax on an $800,000 capital gain, and I have a 50% tax rate, that would be saving $200,000 of tax. which could be per person, which could save the entire family $1 million of tax. If, for example, these shares are owned 20% apiece, and the company were sold for a total of capital gain of $4 million. That's $4 million worth of capital gains tax free on these shareholders. And the Income Tax Act says, if that's what you've got, we'll forget about TOSI as regards that gain. We won't change that gain into dividend income, which, thank you. It's pretty awesome. That particular thing, referred to as the capital gain deduction or capital gain exemption, is the most honest to God important planning thing that you'll learn about in this entire course. And we'll talk about it more when we talk about selling corporations and businesses. And thank you to the act or whomever lobbied for this that said, well, look, we get this idea that you think that people are sort of doing something to change dividends into capital gains or something, so TOSI will apply to capital gains. Okay, we get that, but over here on this other page in the act, you've got this thing where you're making it possible for entrepreneurs to sell and enjoy a large capital gain on which there's no tax. Could you please make this TOSI thing harmonize with that? And they did. Thus, no tax payable on capital gains on which the capital gain deduction applies. So to summarize, 4 bullet points on top of page 329. These are the exemptions that I'd like you to know. And I will change the lecture notes, which speak to only the top 2. I've changed my mind and expanded the scope. That's good for today. Have a good week.